Trading is like buying and selling things you think will change in value over time. Today, we'll break down different trading styles so you can understand how they work. Intraday trading or day trading. Intraday trading involves buying stocks and selling within the day. Let's say you're a fruit vendor selling fresh fruits at a stall. You purchase apples in the morning and sell the entire lot by the evening to prevent spoilage. Day traders do the same for stocks. Buy and dump in the same day. You buy 10 stocks of PepsiCo at $130 each at 10 o'clock. At 3 o'clock, the price goes up to $135. You sell them and gain $5 on each stock, totaling profit at $50. If the price slides to $125, you sell and lose $50. Intraday trading involves monitoring prices throughout the day. Swing trading. Swing trading involves holding stocks for a week or two to get caught up in price swings. Think of it like flipping a house. You purchase a house, make a few changes for a couple of weeks, and then sell for a higher price. Swing traders buy stocks they expect will go up soon and sell when they reach a goal. Likewise, you buy stocks of a fashion brand before the festive season, expecting increased sales. After 2 weeks of festive season, stock price goes up. You sell for a gain. This ranks as one of the most lucrative types of trading that offers more freedom, as you don't have to spend the day glued to the screen. Position trading or long-term investment. Position trading involves holding stocks for years or decades. It's planting a fruit tree. You take care of it over the years, and over time it grows and bears fruit. Investors buy stocks of reputed firms like Apple or Google and hold on to them for years or even decades. You buy stocks of an EV company because you think it will take off. 5 years later, the company performs well, and the investment doubles. Position trading doesn't require daily effort and relies on long-term trends. Options enable you to pay a fee upfront for the option of buying or selling a stock later at a certain price. Assume the scenario of booking a concert ticket. You shell out $10 today to get a $100 ticket price. If tickets go up to $150, you will still pay $100. If prices go down, you don't care about the ticket and end up losing just $10. Let's understand it otherwise. You spend $100 on an option of buying 100 Walmart stocks at $90 each within a month. If stocks go up to 100, you'll use the option and buy at 90 and make a profit of $1,000 immediately. If stocks go down to 80, you don't exercise the option and lose just $100 you have paid earlier. If you allow the option to lapse, then you just lose the fee, keeping initial risks lower. But then you need to understand the contracts. Futures trading. Future trading involves a contract for buying or selling something like oil or wheat at a predefined price on a specified date. For instance, a wheat farmer commits to selling 100 bushels of wheat at $5 a piece within 6 months. If drought sends prices up to 7, the buyer pays 5 for each of the bushels. And if the price falls to $3, the buyer still pays $5. Buyer overpays and spares himself from the threat of losing, therefore shielding the farmer from the risks of changing market conditions. Forex trading. Forex trading involves trading currencies. Think of exchanging dollars for euros before traveling. The trader makes profit if exchange rates fluctuate. For instance, if $1 equals €1 today and $1 tomorrow equals €1 and 5 cents, then the euros you hold are now worth less than dollars. Likewise, assume you exchange $1,000 for 1,000 euros today. A week later, the exchange changes. Now, $1 equals 0.9 euros. You exchange 1,000 euros back and receive about $1,111, making you a $111 profit. Forex market responds to world news, geopolitics, and world trade happenings. It needs knowledge of the economy, world affairs. Algorithmic trading. Algorithmic trading involves executing trades using computer codes, or simply bots. Think about a thermostat regulating the temperature of your house. If the room reaches 75 degrees Fahrenheit, it switches off. The trading bot buys and sells stocks when the prices reach certain points, quicker than a human. Assume a bot set to buy the stock of Amazon if the price falls to $180 and sell when it reaches $185. It makes hundreds of trades a day without human intervention and emotion. Scalping. Scalping involves making dozens of small trades every day for small gains. It's like getting coins from a vending machine. One coin isn't worth much, but 100 coins do. Scalpers make profit from small price movements that don't necessarily end up changing the price of the stock much. Scalper buys 1,000 stocks of Tesla at $280 and then sells at $280.05 after 30 seconds, making a profit of $50. He does this 20 times a day for a profit of $1,000. Scalping needs speed and attention. Derivatives. Derivatives are a contract on the price of something else, such as stocks or oil. Think of insuring a phone. You pay a company a premium. You get compensated if it gets broken. Derivatives allow you to take a bet on price movement without owning the good. You take a derivative bet that the price of oil will go up. If the oil price rises from $70 to $90, you make a profit. And if the price falls to $50, you lose the initial premium. Momentum trading. Momentum trading involves buying up stocks that have gone up a lot lately and selling stocks that have gone down a lot lately, betting that the trend will go on for a while. It's like riding the wave. If a tech firm's stock rises 10% over 3 days due to good news about the company, a momentum trader might buy expecting the excitement to keep propelling the price upwards before selling for a quick gain. Start small, keep on learning, and never risk something you can't afford. Don't forget, trading isn't a path towards wealth. It's a craft earned over time. Stay curious, be patient, want to learn more? Comment below the subject on what you want me to talk about next. And subscribe.